distinguished guests, fellow speakers, honored guests, ladies and gentlemen. It has always been my pleasure to be an integral part of the annual Kuwait meet. It's an extraordinary feel for me to realize. Since yesterday morning, I've seen the new energy in Kuwait. I met the bankers, I met the regulators, I met the business community. I had a very interesting conversation about the change in dynamics in the world and the region. The changes are typical challenges. At the same time, we see a huge transformation happening in Kuwait. With the changing face of the world on account of globalization, re-regulation, technology and consumerism, we have, even after 7 years of financial crisis, last week when IMF spring meeting took place in Washington, D.C., we have seen the reflection that global growth has been downward revised. When we first realized in 2008, when Lehman Brothers collapsed and Bear Stearns was bought over, we recognized we have to fix the liquidity issue. G7 has become G8, G8 has become G20. We took initiatives to improve the money supply, inflate the financial assets, and a technique called quantitative easing, accommodative monetary policy by which we printed money. U.S. Federal Reserve started, trillions of dollars have been put into the money supply chain at the transcended borders and started inflating the housing market, which was responsible for the collapse. American pursuit was followed by Bank of England, followed by European Central Bank, which was technically under recession, and again, Abenomics 3 years before replicated. With the improved liquidity, financial conditions were improving, and we have seen stock market recovering world over. Hot money transcended borders, and in fact, essentially, it inflated the stocks. Currencies were absolutely volatile. An extraordinary set of deliberations took place whether the world is recovering or not. America realized a couple of years before their economy is getting into the right rhythm. The housing market was recovering, purchasing power parity was improving, and essentially, they also realized it's time to increase the interest rate. They sent mixed signals to the international markets, which has decelerated the financial markets, stocks, currency, bond, and properties. When you administer a currency, you have administered the very essential barometer of the system. Universal standards have been set in how the currency should be managed. And when you start weakening it by improving additional supply, irrespective of the intrinsic strength, you have artificially altering the basic mechanism. That's precisely happened. And the world at large has realized it was a currency manipulation. It was all right as long as it was limited. When we took a collective decision in G20 way back in April 2009, quantitative easing is the right solution to inflate the world, it was unified. When Americans have unilaterally started realizing global growth is at stake, at the same time, it's a competitive offering to see American economy is recovering and it's time to increase the interest rate. The world at large got weakened again. There was deceleration in the emerging markets, in currencies and commodities. We are still facing the changing dynamics, and financial markets have become gambling grounds. Extraordinary set of speculation is taking place in terms of currency market. With the reflection of the currency which is getting altered in tandem, you have serious reflection on the commodity side. And that is precisely the reason why the regional reflection of downward trend for the oil, natural gas, and petrochemicals. It's not only currency. The global trade has reduced. Global investments has been transcending from developed world to developing world. And global finance is still, I have not set universal standard in terms of accounting, valuation, and securitization. That has triggered enormous amount of disparities. United Nations have realized they have to set in new Millennium Development Goals. They converted the originally spelled out Millennium Development Goals into Sustainable Development Goals last October 2015, and they set universal frameworks to eradicate extreme poverty. Universal framework in terms of gender equality. Universal framework in terms of environment sustainability. COP21 in Paris was an eye-opener for us to realize there are alternates which needs to be creating carbon neutral society. And again, essentially, education and healthcare has to be set in as universal standard. World at large have realized inclusive growth, making sure developed world and developing world coming together in real terms, contentious issues needs to be moderated and common grounds needs to be inculcated to see world at large can be regaining its momentum. But reality remains still we are speculative. Reality remains still we have growth less than 2009. That's the reality. What are the changing dynamics? How do we recognize the market opportunities? What is likely to happen in the commodity-driven economies like the Gulf states? What is the specific focus of Kuwait? What sort of reorganization taking place in Kuwait and how it can be an impetus for you to realize it's an important opportunity to cash in? What sort of reorganization required in your functional makeup in terms of business modeling? And how do we make sure we create opportunities out of the current crisis? And that's precisely the thought going in our spectrum to see we need to do a knowledge sharing session. Looking at a bigger picture in real world, America has prematurely hiked the interest rate last year in December. That was premature. Subsequently in February they realized perhaps they have to reverse the decision. That's not practical. So they reduced, instead of having interest rate hike as originally spelled out 4 times, they moderated to 2 times. We have also seen the International Monetary Fund sending signals, world economy still in tatters. We haven't set in so-called universal standards, and politics and economics were not converging in many parts of the world. America alone, by fixing the monetary policy, by improving the liquidity supply, they cannot achieve sustainability. We have seen their growth is uneven. There's a synchronized slowdown in the New World Order. We have seen the reflection in Europe as well. Europe is sending a different signal. While Americans have stopped printing money, we have realized the rest of the world wants to go ahead with the quantitative easing techniques. That is, again, heterogeneous monetary policy has created a new impulse to see what sort of reorganization required in the global functional makeup to bring in sustainability. While the monetary policy is centralized in Europe, a fiscal policy in enlarged Europe of 19 countries has got a different spell. Still, they are coping up with. American growth this year, as measured by International Monetary Fund, is going to be not more than 2.2%. It was confined to 3.5% as originally estimated 2 years before is in dismay. A global growth itself, when we met in International Monetary Fund last year in October in Peru, Lima, it was originally estimated around 3.4 to 3.6%. Now, it's likely to be 3% or between 3 to 3.2%. Europe is going to do around 1.5%. You have seen the reflection in Japanese economy. It will downward revise from 1% to 0.5%. And the UK should do, instead of 2.2% to 1.9%. It means The world at large is again contracting in its original estimation. While the emerging economies, which were responsible for incremental productivity and incremental growth, and really that is the economic engine of the world today, is also slowing down. What's happening in one part of the world resonates in the rest of the world, and we have seen the reflection downward. China is slowing down, and last quarter it was estimated 6.5% is realistic. Mind you, gone are the days China was the interconnectivity for the entire economic engine of the world. India is a shining star, sustaining its credit at 7.5%, but we have seen policy makeup is still needs convergence. Politics and economics need reorganization. While the Middle East, which used to produce around 1.8 to 1.9 trillion dollars as their gross domestic product, with a current account surplus of 20 to 25%, a fiscal surplus between 7 to 8%, in the last 20 months have gone through a different spell. Now, if you look at the breakdown as given by IMF last week, it is Saudi Arabia, which is going to produce around $544 billion. $356 billion has to come from United Arab Emirates. And again, Qatar should report around $192 billion. And Kuwait should report $128 billion. Oman should deliver $61 billion. And Bahrain should be $31 billion. If you sum it up, from 1.9, it has come to 1.412. That clearly shows the reflection in terms of the gross domestic product and the impact it has got in the local systems. The liquidity which was conceived time and again as a possible surplus has turned into negative, current account deficit, fiscal deficit, absolutely. Expansionary fiscal policy in terms of urban development, airport, seaport, road, rail, are all now moderated. From nice to do to must do is what the focus is all about. The Gulf states still contemplating an option in multiple form and substance. Yesterday I was in CNBC television here. Doha round, is it a failure? When OPEC and non-OPEC came together, and again trying to come together for production freeze, there were no decisions. When it was $26 in February, oil price per barrel, the Doha talks resulted in reversing the trend, and possibility of reaching 30s and 40s was visible. And again, yesterday was not a failure in substance. It was a missed opportunity, you can say. Now we have to wait and see what sort of decisions comes in as a concerted efforts in June in Russia. While the commodity-driven economies are going through rough patches, mind you, if you look at the six states put together, still the expansionary fiscal policy is significant. If you look at the current year budget alone, topping the list was United Arab Emirates, showcasing the government expenditure of $56 billion. Then comes Kuwait with $31 billion, $25 billion from Qatar, and $25 billion is also coming from Saudi Arabia. And reflection is also there for the rating agencies. They started reorganizing their outlook. Out of 6 states, they downgraded Saudi Arabia from A plus to A minus, and that has got impact in borrowing cost and capacity to borrow money across the globe. They have to liquidate additional surplus money and put it in the local liquidity. We also have seen the downgrading in Oman, BBB minus. Bahrain has been put below the investment grade, mind you. The rest of the 3 states, namely, Kuwait has got the strongest credentials in real order. I'll explain you in a minute. And again, AA rating was reaffirmed for Kuwait. It was reaffirmed for Qatar. It was reaffirmed for United Arab Emirates. But if you look at the economic fundamentals, the strongest economy is Kuwait. How? If you look at the external reserves, if you look at the monetary base, if you look at the underlying economic fundamentals, I mentioned to you 128 billion should be the GDP, but still it can run in current account surplus. Leave the government fiscal deficit. Still, the monetary base is the strongest 375% cover and ability to meet the current account payments not less than 70 months, nearly 6 years of without oil revenue, Kuwait can sustain its current account payments. That's very strong credential. Nowhere in the world you have such economic fundamentals. In comparison, if you look at Qatar, it has got ability to meet the current account payments for 4 years and 150% of the monetary base as against Kuwait 375. It means central bank has got huge cash with them. Then comes UAE can hold it good for 24 months. Saudi can hold for 15 months. Oman can hold for 5 months. These are real statistics which can measure the credentials of the economic barometers. The reason why I'm trying to articulate all these numbers is to recognize Gulf economies are redefining in terms of a fiscal and monetary breakup. Fiscal policy to realign and making sure they still run in a deficit budget, every single country. So after 16 years, Kuwait has put a very strong budget. Still, the second development plan is showcasing $106 billion worth of government expenditure. This year alone, as I mentioned, $31 billion, if you look at a split up, 30 different projects have been spelled out with the public-private partnership model. And again, the initial public offering is integral part of the project management. Those are not ordinary decisions. Gulf as a whole coming together in instituting, dismantling the subsidies, possibly bringing VAT as a structured solutions to have service tax, and they have to reach consensus and converge to, in terms of policy makeup, perhaps in June. There are changes which are coming to reorganize the fiscal prudence, financial stability. But we have to understand the government credentials are so strong, economic fundamentals is going to hold the financial stability in tandem. With the change in face of the Gulf states, the oil price is a question of reality. But if you ask my personal opinion, I've been saying time and again, it is not a reflection of demand supply alone. Currency played a big role, which I mentioned. Dollar index itself has grown from 74 basis points 2 years before, today 100 basis points, now it is 94, 95 basis as a basket of currency. When oil was over $147, it was not the spot deals. It is not the sheer demand and supply. It is speculation. It is oil futures which was driving. When dollar was weak, we had the risk by buying commodity futures. Now, with the current reflection of additional supply which is likely to come from Iran, they couldn't reach a solution in Doha meet day for yesterday. But we have impending challenge to recognize US rigs are getting closed as non-OPEC hydraulic fracturing is failing. Gone are the days where we have 1,700 rigs were operating, pumping left and right, excess supply in the global market. Now it is waning. Yesterday's report says 392 rigs are fully operational. It clearly shows they are not able to get the break-even less than $50. There are reasons to believe the oil price, if the global currency makeup is getting moderated, America itself cannot afford a strong dollar if they have to be export-driven. 12% of global exports lies with American economy. And they have to moderate their currency. That will trigger again the oil price. On average, I foresee, irrespective of the additional supply which comes in, the net will be not more than 500,000 barrels of oil, including the maximum capacity pre-sanction level of Iran. If you take into account, it cannot generate net surplus of more than 500,000 barrels of oil. What does it mean? It means, looking at the aggregate terms, the oil price should average out this year not less than $45. Qatar has taken a budget of 48. Kuwait has taken $25 per barrel. It's a very conservative estimate. The budget itself is 62 billion government expenditure, 24 billion is the government revenues, and 38 billion is a deficit that can be balanced by external borrowings. So there are enough analytics for us to believe we have to reinforce our faith in the economy. We have to change the business model. We have to redefine your existing operations. If you need to rationalize, you have to rationalize. You have to do internal integrations, recognizing the functional makeup of the economies. And to elucidate further on the concept, opportunities in Kuwait, in bilateral terms, there are enough intra-Gulf opportunities are mushrooming. Qatar and Kuwait is generating over $7 billion of transactions. Airport, seaport, road, ride, FIFA 2022 is again shaping up. There are many projects are coming up. I could see many Kuwaiti businessmen coming to Qatar. Our intention is to generate bilateral opportunities in terms of trade, investment, banking, and finance. To elucidate further, with me, an elite panel, Mr. Hamad Asawi, experienced banker and Secretary General for the Banking Union. And again, we have Mr. Anand Banerjee. We also have Mr. Lokesh Malhotra and Mr. Faris. All are there to give you the current stock of things and how you can redefine your business model so that you can make the most out of the changing dynamics. Every change is an opportunity. Every crisis is an opportunity. It's a question of knowledge management. Interpreting these changes positively to your advantage is going to make you successful. That's precisely the purpose of today's evening. I'm sure we'll have a wonderful evening, and you can be more interactive. You can ask questions after every single speaker's session, and we will make sure you will have interesting and enjoyable, exciting evening. Thank you, ladies and gentlemen, for your kind attention.